Grace, it has been an incredible month, an incredible week. We're in the middle of earnings season. You've got stocks like Apple and LVMH posting absolutely amazing numbers, yet they're not really getting significantly rewarded for it. What do you do in this kind of environment if you are a bottom-up stocks analyzer and you're trying to figure out what are the right calls and what are the wrong calls?
Thank you for having me, Guy. First of all, you do nothing. You do nothing. You've set your strategic asset allocation and you keep it there. Tactically, however, you can make some changes. I would hold more cash and I would hold safe stocks. I like the dividend aristocrats. I like utilities. I like boring. That's what I would do.
Kate, we just have a red headline crossing the Bloomberg terminal right now. Wall Street has been briefed by the Biden team on possible Russian sanctions. We understand Citi, Bank of America, and JP Morgan are among the firms in discussions on these Russian sanctions. We'll have more on this from our Anne-Marie Horder down in Washington in just a moment. But from a market perspective, Kate, how do you look at the Ukraine-Russia issue and what kind, if any at all, of a geopolitical risk premium is in this market right now?
I don't look at those things at all. I don't think they're very important. In the short term, they will affect the market. They'll affect volatility. Longer term, they're really not very important. I don't know any market watcher who's saying I'm going to buy stocks or not buy stocks because of Ukraine. I think it'll sort itself out. Now, could it affect fundamentals for a gas utility in Ukraine, in Europe? Possibly. Anything short of that, I think it's market noise.
Okay, there's a lot of noise around at the moment, Kate. How are you figuring it all out? You've got, obviously, the Fed. The market is going from 2 hikes to 3 hikes to 4 hikes to 5 hikes. Bank of America says 7 hikes. How are you factoring that in? I spoke to you before Christmas, and you said you want to be fully invested in this market. Does that still apply when we still don't know what the Fed is going to do and ultimately how aggressive it's going to be, because we don't have the data yet to make that determination?
No, it does not still apply, Guy. Look, we had 3 great years. Last time we spoke, I said there's going to be a Santa Claus rally and then watch out in January. Here we are in January. You got to go safe. This market has been very clear. The Fed has been very clear. The Fed is going to raise rates. This is going to affect the market. When the Fed chairman spoke, he was very clear. He cares about the real economy. He does not care about the stock market. The Fed raise may or may not affect the real economy, but if you're holding equities, I would be very careful in this environment. High beta growth names, no way.
Kate, if we have to go safe, does that mean going to cash?
Going to cash is always a beautiful thing. You don't have to go to cash. Again, there's some great dividend paying stocks that you can go hide in if you don't want to go to cash. Because the problem with going to cash is we're still in an inflationary environment. So you're going to go into cash and you're going to miss out on 7% a year, 6% inflation. I would rather go into some dividend paying stocks. Okay, there are lots of them out there. They're boring. They don't grow much. They give you a nice 4.5% yield. There's several.
Yep. Is that going to be enough? Is that going to be a relative outperformance? Are those stocks going to be going up this year, or are they just going to be going down less, Kate?
I think they're going to be going down less. If you're lucky, they're going to be going up. Some of the energy names we like, something like a Cheniere, I think that's going to be going up. The energy names are going to be going up. Some of the other ones, AbbVie I think is very interesting. Nice yield, realty income. But in a general sense, you're not going to escape the big move. This market is probably headed into bear territory. You're not going to escape that. So I think at the very least, you can protect your assets a little more. I would also look at going into fixed income. I think that would be interesting. The 10-year is at 2%. Okay, we talked about there is no alternative. Now you've got an alternative. Going to the 10-year yield at 2%, not bad.